Welcome to Burns Hustles, where we turn side hustles into cash. Have you ever wondered how dividend investing works? Or perhaps what makes it an appealing strategy for many investors? Well, let's dive into it. Dividend investing is a strategy where you buy shares in companies that pay out dividends. Now, for those who may not know, dividends are a portion of a company's earnings distributed to shareholders. It's like getting a slice of the profit pie. This strategy is a wonderful way to create a steady stream of income, almost like a river of cash flowing directly into your bank account. It's no surprise then that dividend investing is particularly attractive to those who seek to create a passive income, money that you earn without having to work for it daily. It's also appealing to those nearing retirement, providing a cushion of income. But how does one go about building a portfolio of dividend-paying stocks or ETFs? Stay tuned to find out. First, let's delve into the basics. What are dividends? Picture this. You're a shareholder in a company. This means you own a piece of that company, however small it may be. Now, when this company makes a profit, it has a choice. It can reinvest all of it back into the company, or it can share a portion of these earnings with its owners, the shareholders. This shared portion is what we call a dividend. So, dividends are essentially a slice of a company's earnings that are distributed to its shareholders. But it's important to note that not all companies pay dividends. Those that do are often well established with a track record of generating consistent profits. They're usually in a stable phase of their business cycle and have less need to reinvest all their earnings back into the company. Now, how do companies distribute these dividends? It's typically done in one of two ways. The first and most common way is through cash payments. Shareholders receive a certain amount of money for each share they own, often on a quarterly basis. Think of it as a paycheck, but for owning a piece of a company. The second way is through additional shares of the company. Instead of receiving cash, shareholders get more shares. This is called a stock dividend. Companies might opt for this method if they want to conserve their cash. It's also a way for shareholders to increase their ownership in the company without having to buy more shares on the open market. So, in a nutshell, dividends are a way for companies to share their success with their shareholders. They are a form of income that comes from your investment in a company. But remember, not all companies pay dividends. It's a choice they make based on their financial situation and business strategy. Now that we understand what dividends are, let's move on to the process of dividend investing. Dividend investing may seem complex, but it can be broken down into a few simple steps. Let's unravel the process together, shall we? First, your task is to identify potential dividend-paying companies. These are typically established, profitable corporations that share a portion of their earnings with shareholders. They may belong to sectors like utilities, consumer goods, or real estate. Remember, not all profitable companies pay dividends. Some prefer to reinvest their profits back into the business. Next, you'll want to evaluate the company's dividend yield. This is the annual dividend payment divided by the stock's current price. It's expressed as a percentage and tells you how much bang for your buck you're getting. A higher yield may seem attractive, but it's not always sustainable. Be wary of unusually high yields, as they could indicate a company in distress. The third step involves examining the company's payout ratio. This ratio shows what portion of the company's earnings is paid out as dividends. A lower payout ratio may suggest the company has room to increase its dividends in the future, but a higher ratio might not leave much room for growth or could even strain the company's finances. Once you've identified promising dividend stocks, it's time to purchase shares or ETFs. Exchange-traded funds or ETFs can be a great option for beginners since they offer instant diversification. They bundle together a variety of stocks, so you're not putting all your eggs in one basket. Speaking of diversification, it's a crucial part of building a robust dividend investment portfolio. Spreading your investments across different sectors can help reduce risk and provide a steady income stream. So try not to concentrate too heavily on one industry or company. Now, don't think the work ends once you've made your investments. Regularly review your portfolio to ensure it's performing as expected. Make adjustments as needed, and remember, patience is key. Dividend investing is a long-term strategy. Building a portfolio is just the first step. What comes next? Let's find out. Once you've built your dividend investment portfolio, it doesn't mean your work is done. That's merely the beginning of your journey. Now, it's time to keep a keen eye on the performance of your stocks or ETFs. This is not just about checking the price daily, but understanding the fundamentals of your investments. Are the companies you've invested in still performing well? Are they maintaining or increasing their dividend payouts? Are they operating in growing industries? These are some of the questions you should be asking yourself regularly. Monitoring your investments is an ongoing process. It's like tending to a garden. You can't plant your seeds and walk away, expecting them to bloom without any care. You have to water them, prune them, and sometimes even replace them. Similarly, in the world of dividend investing, you may occasionally need to rebalance your portfolio based on the performance of your stocks or ETFs and the changes in your financial goals. Now let's talk about the magic of reinvesting dividends. You see, when you receive dividends, you have a couple of options. You could spend the money, or you could reinvest it back into your portfolio. When you choose the latter, you're essentially buying more shares without spending extra money. This is where the magic of compounding comes into play. Compounding is the process where your earnings generate even more earnings. Think of it as a snowball rolling down a hill. As it rolls, it picks up more snow, growing bigger and faster. When you reinvest your dividends, you're increasing the size of your investment snowball, allowing it to generate more dividends, which can then be reinvested again. Over time, this can significantly increase your returns. So we've covered the basics and the process. But why would someone choose dividend investing over other strategies? Well, that's a topic for our next scene. Stay tuned. Scene script. Dividend investing boasts several advantages that make it an attractive strategy for many investors. Let's dive into these benefits to help you see why it's such a popular choice. First and foremost, dividend investing can provide a steady income stream. This is particularly appealing to those seeking a regular return on their investment. When a company is profitable, it can choose to distribute a portion of these earnings to its shareholders in the form of dividends. This means that as an investor, you'll receive regular payments just for owning the stock. It's like having a job where you get paid simply for being part of the team. Another great advantage is the opportunity for compounding through reinvestment. Picture this. You receive your dividend payment, and instead of spending it, you use it to buy more shares of the company. Over time, these reinvested dividends can dramatically increase your overall returns. This is the magic of compounding. Earning income on your income. It's like a snowball rolling down a hill, gathering more snow and growing larger with each roll. Additionally, dividend investing can often be a lower risk strategy compared to others. Companies that regularly pay dividends are typically well established, with stable earnings and a proven track record. This stability can make for a less volatile investment experience. After all, a smooth ride is always more enjoyable. Finally, dividend investing can be a hedge against inflation. As the cost of goods and services increase, companies often raise their prices, leading to increased profits and, in turn, higher dividends. This means that over time, your dividend income can keep pace with the rising cost of living, protecting your purchasing power. And there you have it, a straightforward guide to understanding dividend investing. It's a strategy that requires patience and discipline, but the potential rewards make it worth considering. Investing in dividends can be a lucrative strategy if done right. This is the takeaway from our conversation today. We've explored the fascinating world of dividend investing, a realm filled with potential for those willing to navigate its intricacies. We've discovered what dividends are, the portion of a company's earnings paid out to shareholders. We've walked through the process of dividend investing, highlighting the importance of selecting strong, reliable companies or exchange-traded funds that regularly pay dividends. We've also underscored the advantages of this strategy. Dividend investing can offer a steady income stream, even in volatile markets, and the power of reinvesting dividends can compound your earnings over time. But remember, it's not just about understanding the concepts, it's about applying them, monitoring your investments, and making necessary adjustments along the way. Thank you for joining us today. Remember, investing is a journey, and every journey begins with a single step. Start yours today.